Okay, folks, welcome to Best Stock Charts for the coming week. This is Bob Desmond, and it is December the 8th. What a week, huh? Extremely volatile. What we're going to do today, the topics are going to be, one, how we did last week. We took 4 trades off the table. 3 of them were winners. 1 was a loser. I'll skim through the winners quickly. If you want me to do a video about how we set up the trades and how we booked our profits on the winning trades, leave a comment below. What I'd rather do is spend this time today talking about our losing trade. We cut losses. We'll talk about position sizing and how it related to this particular trade and what prompted us to take a small loss when we did. Then we're going to segue into market signals. And what I'm going to do is I'm going to go over a series of charts that have been telling us about the weakness that we're experiencing right now in the markets we called the top and the FANG names back in August of 2018, and they are weak and getting weaker. Then we're going to segue over and into our watch stocks for the coming week. And if you watch this video all the way through, I'll share with you my favorite long trade for the longer term, as well as my favorite short trade. Stick around, watch the entire video. And if you would, at the lower right of your screen is a subscribe button. If I could ask you to click that, I'd truly appreciate it. Let's get to it. Okay, so trade number 1 that we took off the table last week, this is a winning trade. The EDC, which is the Emerging Market Bull ETF, we opened up our trade right here on November the 16th. We were flirting with a breakout above resistance. Then on the 28th, we rallied, we broke out and through the upper band of resistance. And then I decided on the 4th to book profits, because what we did on the 3rd is that we rallied up and into resistance. And then on the 4th, we began to take out the prior day's lows. And that was our strategy, to stop out of the position if we took out the prior day's lows, because that is not the technical action that you would expect to see on a stock that's poised to break out. So EDC, we booked profits of $4.20 per share, or a 6%, a little more than 6% profit. So nice trade. The next trade that we took off the table was Canada Goose Holdings. We opened up this position right here on the 28th of November on this bullish key reversal after a retest of the lower band of support. The shares had been showing relative strength versus the S&P 500. They had recently reported very strong earnings. So the logic used was that if, in fact, we were to get a Santa Claus rally fueled by the quote-unquote trade deal that was negotiated over in China last week, well, then you would expect market leaders such as Canada Goose to lead the way higher. So that was the logic. Now, we did break out on the 3rd, but given the price action that day, the hollow-filled candlestick, very close to an all-time high, I said, you know what? Let's allow for a pullback and a retest of the breakout point. I don't like this price action. So we booked our profits, and thank goodness that we did, because the shares just kept falling. And this is called a breakout point failure. When you break out and then you fail to hold support and you drop back down into the trading range from which it just came from, well, then at a bare minimum, you're going to come back down and retest the lower band of support. And there's a high probability, especially in this market environment, that we break support and head lower. And that's exactly what we did. And we're probably going lower from here. I still like Canada Goose longer term, but right now the shares are weak and they're probably going to get weaker. So this trade here, we booked a profit of $3.12 per share, or a 4.71% profit. Nice trade. The next trade that we took off the table, we actually traded twice. The first closing trade, we booked a profit. The second closing trade, we booked a loss. Let's do a quick walk through our initial long trade here, because it matters. How we put this trade on is exactly how I like to trade any market, especially this kind of market where you have a market that is weak and getting weaker. You need to buy in increments. So if you're dead set on buying, in this case, TNA, which is a leveraged ETF, putting you long of the Russell 2000, if you're dead set on buying 100 shares of the TNA, well, your first buy should be no more than 20 to 25 shares. If you're wrong and the shares break down, well, you stop out with a small loss. You live to play another day. However, if you're right and the shares continue higher up and through resistance, well, then you can tack on another 25 shares. Now you've got 50% of your overall allotment, your intended allotment, filled. And as you proceed higher or on an orderly pullback and a retest of support, you can add more, so on and so forth. So this is how we put on this trade. It all began right here on November the 26th, where the TNA was able to finally break and close above resistance at the 59.89 level. We opened up our position here on the 26th at $60.72. Then on the 28th, when we flashed this bullish key reversal bar, we added more because the market was telling us that we were right in our decision to get long of the TNA. The market was sending us signals. So we bought more at $61.60 per share. Then on the 30th, right here, where we flashed this bullish reversal bar, we added our final allotment at $63.89 for a basis cost of $62.00. So this brief trade here resulted in a $7.32 per share profit, or 11.79%. So a very nice trade. Now, the TNA just happens to be where we also took our loss, because I opened up a position here on the 6th on this reversal day. Now, it wasn't a bullish key reversal day, meaning that we rallied to close positive on the day. We came close, but no cigar. But we did manage to recapture support. So the thought process here was that, okay, maybe what we'll get here is a setup, a W formation. Here is the left side of your W. Hey folks, thanks so much for watching, and we're going to begin again in just a moment. But first, I wanted to make a really big announcement. I'm really excited about it, and I think you're going to like it too. And the announcement is this: I am going to be raffling off a 1-year gold level membership to the Contrarian Trader. That's right, trade alerts, daily commentary, paper trading simulator, access to the members forum. And I will be announcing the winner on January the 5th, 2019. All you need to do is pause this video, click the subscribe button, click the like button, and you're in. That's it. So don't wait. Enter now. I'll say thank you in advance, and let's get back to the rest of the commentary. Here is the left side of your W. Here's the center point, with the peak being at 71.52. And here was the anticipated right side of the W formation forming. Now, were we to rally up and through 71.52, well, then it would be game on to the long side, and I would have added more. However, while we did follow through to the upside after opening our position here on the 6th, we did put a new daily high in on the 7th. The problem is that we reversed on the day, and we had what you call an outside reversal day to the downside. This is a very bearish candlestick. So while for a brief moment we were accurate with our directional call that we would probably head higher, in the end we were proven wrong. And the ability to say, you know what, I was wrong and I need to cut losses is what is going to get you through this market. So on this trade here, I took a $2.73 loss, or a loss of 4.87%. But net on the week, it was a very positive week on our realized gains. Now, on our unrealized gains, we were up far more because we are net long of the gold mining names such as NUGT, where we rallied last week alone 17.64% on the week. And we are very close to a major breakout here, but not quite. Members will talk about our positions on Sunday on the week ahead commentary, which is where I'll do a deeper dive into the major averages. Where have they been? Where are they going? We'll talk about our positions, what our strategy will be for the coming week, and we'll do a deep dive into our focus stocks, which I'll go to in a moment. So NUGT, strong week last week. We are also long of silver using the USLV. That was up 9.94% last week alone, and we're very close to adding more to this position. So you see, folks, while the major averages took it on the chin last week, the positions that we have been building long positions in for months now began to pay off. So while the market was in an unsustainable uptrend and we had an unsustainable downtrend in the gold mining names and in silver, well, we saw opportunity where others were ignoring it, and that was our contrarian trading strategy, which was to build up sizable long positions, because the logic is that when the market begins to roll over, that these positions would begin to rally. And that's exactly what is transpiring right now. So members, more tomorrow about strategy with regard to these names on the week ahead commentary. Now let's talk about market signals. We'll begin with a monthly chart of Deutsche Bank. I have done a few videos with regard to Deutsche Bank. It's been mentioned in many videos. I have been warning for a long time now that there is something very, very wrong at Deutsche Bank. They have a massive derivatives book. Nobody knows what kind of exposure they have to this book of business because nobody understands the derivatives that they've written. And I warned that if we break below $10 per share and we begin to see single digits, that you're going to see massive amounts of short selling. You're going to see massive amounts of institutional distribution, and that's exactly what has happened. The shares alone for this month, they're down nearly 5% on the month. This is Deutsche Bank. This is the largest bank in Germany, if not Europe. And it's not only Deutsche Bank that is not looking good in the financial sector. Take a look at Goldman Sachs. You want to talk about a textbook head and shoulders setup here. I talked about this months ago. Left shoulder, head, right shoulder, neckline. It broke back here the week of November the 12th. And this is what happens. You get institutional selling, program selling when you break these support levels. So this is why it's critical to really use multi-period charts. I talk about this with members constantly. You'll see videos on YouTube by my so-called competitors. They will walk you through what a stock looks like on a 5-minute chart, a 15-minute chart. And sometimes I watch and I say, my God, somebody's going to get crushed one day because they're not talking about what the stock looks like from a higher level view. Meaning, it's fine to look at a 15-minute chart, but first you need to understand what it's doing on a daily chart. And if you're going to use your daily chart as your preferred chart to use when you want to get long of a stock, well, then you need to understand where the stock is trading on a weekly and monthly basis. This linear thinking that is out there must stop if you want to keep your portfolio from blowing up in this kind of market environment. I have been doing this for a long time. I have been through many corrections and 2 massive bubbles, and I profited through them both. But the only way you could do it is by paying attention to the weekly and monthly charts and the signals that the market is sending you. And in this case here, this failed breakout back here where we broke out on Goldman. It broke down to within this trading range back in March of 2018. This is the market. It told you back then there's something very wrong with the banks. It took several months for them to break, but when you see failed breakouts during a bull market, that's a sign of a top. Fast forward, a couple of counter trend rallies, then we've broken. Guess what? We're going lower. But I do think there's going to be a long trade, a dead cat bounce, if you will, in the coming days. So members, stay tuned. We'll talk more about Goldman Sachs as a possible long trade. Other stocks that have been just absolutely decimated yet are considered or were once considered bellwethers, like General Electric, which has been removed from the Dow Jones Industrial Average. We are down in the month of December alone 6.53%, folks. And we are going lower. Now, I do think that there's going to be a long trade to be had here because on this monthly chart, we have RSI at 13.24. It's my guess that what's going to happen here is that at some point in time, they're going to cut this dividend. And you may be saying, you know, Bob, Jesus, isn't that going to be bad for the stock? Won't it go to zero? No, not at all. That will be a contrarian indicator. Initially, it will sell off, and I will be a buyer. If it does not sell off, well then, the yield cut is priced in. I will be a buyer. But that is the next shoe to drop. Expect it. It is coming. Yield cut, General Electric. Members, more to come on a potential trade here. Other signals by the market that not only is the market in trouble, but the economy as a whole, the yield curve. I did a video on this on YouTube a few days ago. I'll see if I can link to it at the end of this video. The yield curve has gapped down after breaking down below the lower band of support last month, and we have gapped down to make lows not seen since July of 2007. I know this is difficult to see. I'll drill down a little bit further for you. Now, how did we trade this information with the yield curve, which has been contracting dramatically, tightening dramatically? It really doesn't influence it all that much. All it is an indicator of possible recession, and we're not even at that point yet. The 2-year and 10-year Treasury yield curve, which is what you're looking at right now, has yet to invert. An inversion looks like this. You can go back to January 2006 through March of 2007, and that's when the Federal Reserve was cutting rates aggressively. And this, of course, was the Great Recession. So I think that the yield curve is going to continue to tighten. I think we are going into recession, so expect lower lows here on the yield curve. So how does it influence our trading? We don't get overly aggressive to the long side unless we have an edge, and I'll talk about an edge later on in this commentary when I talk about some of our unsustainable, extreme oversold stocks that we're watching for the next trading week. Other market signals. We've had multiple Fed rate hikes since the month of December 2015. One would have thought with economic growth, which is supposed to be the best we've ever seen, you'd expect to see a yield able to hold 3%. Unfortunately, it is unable to. We cratered this month back down below a 3 handle on the 10-year yield. This is the market anticipating future Fed rate cuts. Forget about pauses. They're looking for cuts to salvage this economy. The irony is that we'll probably have to get through one more rate hike so that the Federal Reserve can salvage some of what's left of its credibility. So if the economy were going gangbusters, why would Chair Powell signal that after this rate hike, that future rate hikes would be on hold? Why would he do that? So another signal by the market that all is not well. The U.S. dollar, the dollar peaked here the week of November the 12th after breaking out above critical resistance, and we flashed a breakout point failure, meaning we had broken out and then we rolled back over. We did not have enough strength to hold the breakout, not enough buyers. And remember that the currency of any one economy is a sign of strength of that economy. And while relative to Europe, Great Britain, and Japan, the U.S. dollar has held up fairly well, one would think that with riots in the streets of Paris, that the U.S. dollar would be able to continue to rally versus the euro. Unfortunately, it cannot. So the dollar threatening to roll over here. Signals by the market, lower highs on RSI, lower highs on your Stokes, and now we are breaking down to lower lows on both. One of the other signals by the market, and believe me, folks, there are plenty of other signals by the market, but I only have so much time to spend with you discussing these key topics. another sign that there's a problem with an economy, or in this case, a sector of the stock market, is failed breakouts. And the healthcare sector has held up fairly well relative to the overall markets. This is a weekly chart. We had a massive weekly breakout the week of November the 26th. One would have thought we would have continued to rally. What happened last week? Nearly a bearish engulfing of the prior week's move and a breakout point failure. This, my friends, is a short. This sector, the XLV, this sector ETF, just went from a massive buy signal to a short all day long if we make a new weekly low. Because at a bare minimum, I'm predicting that we're coming down here to retest this lower band of support. And if this market continues to weaken, there's a very good chance that we break it and we move lower. Members will talk about strategy as to how we might short XLV tomorrow on the week ahead commentary. So stay tuned. Tomorrow being Sunday. Now, I've given you a lot of doom and gloom here. And I don't want to do that. All I want to do is illustrate to you that this market is under a tremendous amount of stress. The economy is weakening. It's not my opinion. The bond market is telling you as such. Even though you're probably not a member, if you're listening to this, I don't want to see anyone who's taken the time to listen to my commentary to lose money. I appreciate the time that you spend with me. Now, here's the upside. There's going to be a tremendous amount of money made if you're able to grasp what I'm sharing with you today, because we're going to make money to the short side. We're also going to make money to the long side. It's already begun because our contrarian plays are already beginning to work. And not only work, they're beginning to break out in the face of an economy that is weakening and in the face of a stock market under a tremendous amount of stress. And with geopolitical turmoil, that is only just beginning. So where do I see a new bull market beginning? Look no further than what's in front of you right now. Look at the chart of gold. Gold has been putting in higher lows and is now breaking out to higher highs. Last week alone, gold was up 2.17%, where the S&P 500 was down over 4 1/3%. And it appears as though it is going lower. Members, more tomorrow on this chart in particular. Back to gold. Now, I mentioned earlier that I like to use multi-period charts. So this is a weekly chart. I also want to take a look at a monthly chart to validate what I'm seeing here. How do we look on a monthly basis, on a historical basis? We'll go to that chart in a moment. Stick around. But before we leave the weekly chart, take note. Your RSI is breaking out. Higher lows, higher highs. Stokes, higher lows, higher highs. Volume could be a bit better. I will say that. Volume is below average. So this chart is looking really good, monthly chart. In fact, you know what, folks? I'm going to use a quarterly chart just to illustrate how high level I like to go. And you can see that I've annotated this many times before. I revisit it time and time again. And this may shock you. And I hope it does. Because perhaps you'll gain some value out of this video and you could use it for future trades from which to profit. What if I told you that gold broke out on a quarterly basis nearly 2 years ago? What if I told you that? Would you believe me? If you doubt me and you're still watching and I prove it, please subscribe to my channel and share with a friend, okay? So here we go. So I'll take you back here to January 2016. We broke out, and this was after a Federal Reserve rate hike the prior December. We broke out above resistance, and we held it. We pulled back, we retested the breakout point, we held. We put in a high this year in January of 1,369.40 the ounce. That was a new multi-year high. And we haven't seen that price level since back here in April of 2013, folks. So for those folks who were doubting what I was telling you about the quarterly breakout on gold and the new bull market, do I have your attention now? Please, I hope I do. Knowing these charts can help you from getting shaken out of a trade or God forbid, were we to have closed down below this lower band of support here, then I would have known I was wrong and the breakout would be a failure and we would have to avoid gold. I mean, I don't own gold, but I do own a very large position of a leveraged ETF, putting you long of the gold mining names as well as silver. So gold looking outstanding. I'm loving this chart. We are trading at the highs of the quarter. We are in the final month of the quarter. I'm very excited. And once we break out above the year's highs at 1369.40, brother, it is game on to the long side for gold. And nobody's paying attention to it right now. Nobody, except for us. But they will be. Let's talk about the gold miners. Let's talk about JNUG. JNUG outperformed the market last week by a mile, up 15.81% last week alone. We have higher lows on RSI, higher lows on Stokes after a double bottom setup. This is exactly what you want to see. And more importantly, we have a breakout. I would like to have seen higher volume, but I'll take it. What we want to see moving forward are these volume bars beginning to rise. Now, if you don't want exposure to such a leveraged ETF, I get it. Simply look at the GDX. The GDX had a beautiful week last week, up nearly 6% on the week, and we broke out. We were in a triangle formation. If we rally up and through $20.51, we're going to see $21 per share in a heartbeat. If we rally up and through $22 per share, new bull market in the gold miners. Higher lows on RSI. Volume was quite good. It was about average. It was better than the gold. So the GDX looking good. Now, folks, these are all very volatile. Now, I plan on adding to my gold mining trade. I plan on buying gold, but the setup needs to be appropriate. So members will talk more about strategy for buying gold and adding to our gold mining trade on the week ahead commentary. UGAZ. UGAZ has broken out to perhaps a new bull run. Now, I did short UGAZ using the DGAZ a few weeks ago, a couple of weeks ago, and we did a 28% profit on that one because it was just unsustainable, the rally. We were all the way up here above the third standard deviation Bollinger Band, and I knew it wasn't going to hold it, so it was an easy short. We booked profits, and we are now in a tightening triangle formation. So I wouldn't buy yet. I would buy the breakout above this upper band of resistance. UGAZ looking good. Members, we'll talk about the daily chart and what the setup looks like tomorrow on the week ahead commentary. Now I'm going to take you to my favorite short, as promised earlier. Twitter. I have a personal dislike for Jack Dorsey. He's a smart guy, don't get me wrong. But I don't like the fact that he is banning conservative speak on Twitter. I think it's very un-American. And as a fiduciary, as a CEO of a corporation that is publicly traded, I believe it to be corporate malpractice. It's as simple as that. Why do you want to alienate your customers? Without your customers, you don't have a business. Yet he bans them as if he's God. I digress. Twitter, to the technicals. Now, what we're looking at here is the potential, not a guarantee, but the potential for a head and shoulders breakdown. And here you have it. Left shoulder, head, right shoulder. Here's your neckline, right at the 29.87 level. If that breaks, it's all over for Twitter. Now, let's talk about how I could be wrong here, because I want to challenge my own thesis here, because I don't want to be delusional in my trade simply because I have a dislike for the policies of Twitter. So some observations that could disrupt my short thesis here are the fact that Twitter closed up last week. It showed relative strength versus the S&P 500. That can't be ignored. So I could point out to you on this video, look at me, head and shoulders set up, short the stock. No, that's not what you do. You take a look at how you could be wrong. Challenge your own thesis. Look at yourself in the mirror. And when do you know that you are wrong? When I know I'm wrong here is when we close above this upper band of resistance, because the market's been sending signals that these topping tails, wicks, shadows, call them cupcakes, it doesn't matter. What they imply are that we have sellers selling strength. So every time Twitter catches some momentum, sellers move in and they take it down off the highs of the week. That is bearish stuff. But net, we closed up last week. So I'm not ready to go shorting yet. I'm not buying my own argument just yet. Now, if you're looking at RSI and Stokes, and you're making the observation that, you know what, Bob, take a look at the fact that we could be putting in higher lows here. That's a valid point. And I acknowledge it. Here's the problem that I see with both of these indicators. While, yes, we are putting in higher lows on both, the rally up and above the 50 level on RSI failed. It couldn't hold the neutral level at 50. That's a sign of weakness. Now, we did manage to close back above it on Friday. Stokes, the fact that we did not rally up and through 80, then pull back, which is what we would normally do, like we did back here, here. I mean, that's the norm. You rally up above 80, and then you roll over, you put in a higher low, and then it's game on once you begin to hook back up to the long side. Guess what? We never made it to above 80. To me, I read this as weakness. There's a lack of momentum. There is a lack of bullish sentiment. Now, again, when am I wrong? When we rally and we close above $34 per share, then I'm wrong. Then this trade goes off the table. But right now, the bet is that we fail, that we break, because I think this market is going lower. I think it's going a lot lower. And I'm going to talk about the markets tomorrow with members on the week ahead commentary. Folks, if you're not a member, to get the week ahead commentary, I have a very, very low price point to get the week ahead commentary if you're not an active trader. So please subscribe. I think it's $19.99 a month to get that. And there's a lot of value that you gain out of it. Just head over to the website, thecontrariantrader.com. And the new site is going up very soon, and prices are going up, so please jump on it. Current members are grandfathered in prior to the launch. Let's talk now about unsustainable trades, extreme oversold trades. And you can go back, you can take a look at my commentary in the past with regard to trades that we put on. If you're new to my trading style and you're looking at this chart right now and say, my God, this guy wants to buy this stock in the stock market that is correcting? Yeah, I do. Why do I want to buy this stock? Perhaps not on Monday, perhaps not on Tuesday, perhaps not next week, but very, very soon. The reason is that this sell-off is simply unsustainable. What you're looking at in green here is not a moving average. What it is the third standard deviation Bollinger Band. I'll save you the technical jargon. The shares are simply not supposed to be trading here relative to historical price action. Also, RSI on a daily basis is at 7.71, one of the lowest I've ever seen. Now, volume is still very, very high. So I've talked to you a lot about multi-period charting on today's commentary. The same holds true for AVA. I need to know where there is historical support on this stock. And I haven't taken a look yet because there is a strategy if there is no historical support for which to enter the trade. But ideally, I hope that I find historical support on AVA and we'll look to set up a trade at one of those support levels if there are more than one. Members, more tomorrow on the week ahead commentary. And folks, this is not going to be an investment. I'm not even going to try to swing for the fences to try to get a home run here. If I get a rally up and into resistance at 46.50, I'll be happy with that. And that resistance level was last seen back in March of this year, and we sliced through it like a hot knife through butter. The next chart up, Build-A-Bear. Somebody's got to buy a stock called Build-A-Bear. I mean, have a heart for God's sakes. This time of year, the holiday season. So we have RSI here at 13.49. Very attractive. I think we're going lower though. And with a stock that's trading with a 5 handle on it, folks, I can assure you that while you might think that RSI with a 13 handle, it can't go any lower, it can. And it probably will. You can easily see RSI sub 10, especially on a stock that trades below $5 per share. And we closed out the day at $5 yesterday. And keep in mind that AVA has RSI with a 7 handle, and it's a $40 stock. So please do not go charging in and buying these shares on Monday morning. You need to do more analysis on the weekly, monthly charts, and then the intraday charts to identify if we have buyers moving in and beginning to accumulate shares. And more importantly to me, I want to see if the shorts begin to wake up and begin to book profits. To me, that's the money in the bank, getting those shorts to cover their positions. So members, more to come tomorrow on the week ahead commentary. The last chart up today, Tuesday Morning Corp, TUES, the symbol. Now, I will say this about Tuesday Morning and any other brick and mortar retailer. I'm very skeptical of these names. I think that one of the major causes of recession the next time around will be commercial real estate and the exposure that the banks have to it. You have Sears, which is declared bankrupt, just one of the many that is declared bankruptcy. Now, RSI on Tuesday morning is 16.83. The fact that we're trading with a 2 handle right now and the fact that this is a brick and mortar name, I have ongoing concern issues, okay? So I need to do more due diligence on Tuesday morning before I pull the trigger. But I'm going to talk to you today simply on a technical basis. That's it. So again, RSI 16.83. It can go a lot lower. I think it is going lower. Why do I believe that? Well, A, weak stocks tend to get weaker. B, all these topping tails and the fact that we closed down below resistance at $2.45. Every time they try to rally it, sellers move in. Now, the good sign here is that selling pressure is beginning to wane. It's rolling in below average, which is good. We are also seeing higher lows on Stokes, which is bullish. I'm not ready yet to pull the trigger here. More analysis needs to be done. We'll do it tomorrow on the week ahead commentary. Members, stay tuned. Folks, if you got this far in the video, I want to reward you and I want to say thank you. If you'd like me to go over one of your symbols, leave your symbol in the comments below. I'll take the first 3 symbols that are left for me, and I'll do them on Monday's Swing Trading Today, which comes out before the markets open. So subscribe to my channel. Everybody have a great remainder of your weekend and have a profitable trading week next week. Be well. Hey folks, just a really quick thank you for watching this far into the video. I appreciate it so much. And a quick reminder, don't forget about our 1-year gold membership raffle. That's a $1,164 value. And all you need to do is just click the subscribe button, click the like button, and you're entered. That's it. And we'll announce the winner on January the 5th, 2019. I'll see you there. And if you have any questions, leave a comment below.